Well, welcome everybody to the Edgar Investment fourth quarter slash 2023 market wrap up. I'm your host for today, Matt Edgar, and I appreciate you joining me. So what we're going to cover today are some things that are happening here at Edgar Investment. We've got some hot topics to talk about. We're going to, of course, go through markets, take a look at both the U.S. markets in depth, but also the world markets. We're going to take a look at our Edgar sector rotator, how that performed for the fourth quarter, and what we're predicting going forward. We're going to take a deep dive into U.S. and international stocks. Also take a look at some global fixed income, as well as U.S. fixed income. And then we're going to answer some questions. We have a couple questions that have come in at the time of registration, but if you have any questions that you come up with during this webinar, go ahead and put them in the Q&A chat. Just some disclosures. We've done our best to make sure all the information in this presentation is accurate, but we're relying on data sources that may have inaccuracies in their data. So before you go out and take any of this as investment advice, you should consider your own situation and talk to a professional where needed. All right, so what's happening at Edgar Investments? Well, in case you're not familiar with our investment learning lab, that's on our website. This is a resource that includes all kinds of great things like daily investing news. Patrick here in our office produces a daily blog with a couple topics, hot topics from the day. We have our Investments 101 series, goes into a variety of investment topics. We also have some videos that go into investing. And then we have our series on behavioral finance, common behavioral issues that people have when they're investing. So if you're not familiar with that, definitely go to our website, check out the Investment Learning Lab. Also check out our YouTube station. We're putting videos up there. For instance, all of our quarterly webinars, including this one, will go up to our YouTube station, our YouTube channel. We also have other videos that we're in the process of producing that will go into our YouTube station. So whenever you're looking for something to do and you're on your mobile phone or at your laptop, check out our YouTube station. Also, if you're familiar with our daily investing news, you'll know that like I said, that's a blog that Patrick does every day. We wanted to see what's our most used keywords were for 2023. So Patrick went through and grabbed all the words from every blog that he made this year and came up with this little graph of our most used terms. It's not really surprising to me for the most part. You can see AI sort of dominated our blog with 135 mentions this year. Inflation came in second at 98. Some of the things that might be a little bit surprising, like coffee was one of our top terms this year. And technology, advertising, all of those things, tend to be pretty common themes in our blog. So that's a little bit what's going on at Edgar Investments. What was going on with markets? Well, if you remember back to our Q3 presentation, the third quarter was a pretty bad quarter across the board. Whether you were a large cap, small cap, value, growth, you experienced some loss in the third quarter, I'm sorry. Fourth quarter, totally different story. You basically couldn't lose in the fourth quarter. Large cap growth and small cap value dominated with 15% for the quarter, but every asset class across the board pretty much did well. So how does that interpret for the whole 2023? Well, across U.S. markets, large cap, small cap, mid cap, value, blended growth, markets were positive. But you can see large cap growth had a staggering 47% return. And we're going to see where that comes from here in a second. But that's pretty remarkable that large cap growth could post such a high return. But large cap overall overall did pretty well. So you can see mid cap growth had a 25% return, small cap growth had a 26% return. So overall, Q4 was a good quarter. 2023 was a good year. Investors needed that after a bad 2022. So overall, good. We're going to take a little bit more look into this in detail here in a few slides. How about the Fed funds? Everybody's interested in watching what the Fed does. Well, you can see at the very beginning of 2023, we had a few increases. So we had quarter point increase in February, March, April. They did take a pause in June. In July, they were back with a quarter point return, a quarter point increase. And then basically the Fed has paused. They've taken a break, left the Fed funds rate at between 5.25 and 5.5%, all the way up through the end of last year. Our next meeting is in January, end of January. Most people do not expect any movement on that, so we're expecting another pause. The meeting that most watchers are looking forward to is this one coming up in March. If we were back in December, just a month ago, I think most people thought the Fed was going to begin cutting in that March meeting. The market's a little bit unsure about that now. The market's, as we've gotten inflation numbers come out, as we've had strong job numbers come out, it's not so clear that the Fed is going to begin cutting in March. So we'll keep an eye on that. But we do expect that there are probably going to be some cuts at some point in 2024. We do believe that the Fed is going to look to ease interest rates at some point in 2024. It's just timing is not sure, is unsure at this point. So large cap growth just went gangbusters in 2023. Where did that come from? Well, it really came from 7 really high flying stocks. So you can see Apple, Microsoft, Google, Amazon, Tesla, Meta, Facebook, and Nvidia, kind of collectively known as the Magnificent Seven, really posted very strong returns. Specifically, Nvidia and Meta. Nvidia was well over 200%. Meta was up over 180%, but even Tesla was up around 130%. The names on this that had the weaker returns are Apple, and Apple was still at 50%, far outpacing the S&P. So these 7 stocks really, really pulled the performance of the S&P up for the year. Now, what's interesting about these 7 stocks is if you look at their 2022 performance, so that's the bars in red, every single one of these 7, including the S&P, had negative returns in 2022. And the reason this is sort of an important thing to focus in on is if you're an investor in any one of these or in a basket of these stocks in 2022, it was really hard to get to the end of 2022 and not sort of throw up your hands and say, you know what, I'm done with Nvidia, I'm done with Amazon, I'm done with Apple, I'm going to just sell out of those names here on December, whatever, 2022. Well, if you would have done that, if you would have thrown up your arms and just gotten out of Nvidia and Amazon and Meta, you would have missed out on some incredible performance in 2023. And this is why we always caution investors to not necessarily look at what's going on right now, to not watch the news, to not be obsessed with your portfolio, because a lot of times it makes investors, make that wrong move and say, you know what, I'm done. Google's not performing this year, I'm out. And then you miss out on upcoming performance. So a pretty remarkable showing by these 7 names. And it really interpreted into a lot of return for the S&P. All right, so in terms of hot topics, what are some of the tax changes that we can expect to see here, or that we'll see here in 2024? Well, all of the tax brackets have been adjusted for inflation. So, there's a little bit less income subject to these higher marginal tax brackets. So that's good for taxpayers. In addition, the standard deduction has been increased across the board. So if you're single or filing single, you get a $750 increase over 2023 Married filing joint gets a $1,500 increase. Head of household gets an $1,100 increase. So that's a nice thing for taxpayers. We also have increased 401k and IRA limits. So if you're a 401k contributor, you can now put aside 23,000. If you're over 50, you can actually use the catch-up contribution to put away 30,500. On the IRA side, you can contribute 7,000. If you're over 50, you can contribute 8,000. We always tell our investors and clients, max out your contributions to the extent you are able. So if you can contribute 23,000 or 30,000 if you're over 50, do it. Max that contribution out. It's going to lower your taxable income. It's going to put that money into the market so that you're invested. And also, of course, most companies have some sort of match. And so you're getting free money from your employer. So we always, always, always recommend max out your contributions on your 401k. We also have an increase in our gift tax exemption. So this is the amount of money that you can give to somebody without having to pay gift tax on it. And that new exemption is $18,000, which is up significantly over the last couple of years. And then finally, if you're a Social Security recipient, you got a cost of living adjustment, a raise of 3.2%. So that's nice for Social Security recipients. All right, let's take a look at some market performance here. So if we go back and look at the fourth quarter, this is a great chart to see, right? Green across the board. So whether you were in US, international developed, emerging market, real estate, or even any of the fixed income markets, the bond market or the global bond market, US bond market or global bond market, you had a good quarter, right? US had the best quarter at 12%, followed by, global real estate had the best quarter, followed by US stocks, and then international developed and emerging market stocks. So overall, a very good quarter for all asset classes. For the year 2023, similar type results. Here, the best performing market was the US stock market, up 25.96%, followed by international developed. Then we had global real estate. Then we had emerging market stocks, followed by the bond market. So overall, good market, good performance for equity investors. If you had a diversified portfolio, you did pretty well in 2023. Sort of expanding our scope a little bit and looking at the longer term, we already talked about the 1 year. But if you look at like the 10-year performance, overall on a 10-year time horizon, if you're a US stock and market investor, you've gotten 11.48% per year over that time period. It's a little softer when we go to the international. So international developed, the 10-year average is 4.3%. Emerging market has a fairly weak 2.66%. Global real estate, 4.72. If you're a bond investor over the 10-year time horizon, you've seen positive returns. But this really sort of speaks to having a diversified portfolio. So if you're all in stocks, U.S. stocks, okay, you did well. You did 11.48%. But if you made the wrong call and you're in all emerging market stocks, you would have seen a return of around 2.66%. So it really speaks to diversification. Having a well-balanced portfolio that's spread out among U.S. stocks and international developed, emerging real estate, and fixed income, of course. So for Q4, what were some of the key events that have happened in the fourth quarter? One that's moved oil markets for sure and has sort of created some instability in the Middle East was, of course, Hamas invading Israel, Israel declaring war on Hamas. That's an ongoing situation. I think we're now over 100 days into that. On the market front, NASDAQ exited its correction territory and small caps saw their best day in more than a year in Q4. The Dow surged, closing up to about a 2-year high and then the S&P had a record year or near record year with a 24% gain. So on the geopolitical side, there's been, continues to be some turmoil, but markets responded positively to everything for the quarter. Over the last 12 months, if you go way back to Q1 of 2023, you'll remember the Silicon Valley Bank. When that whole thing started to unfold, it looked as though this was going to be bank crisis 2.0. I mean, that really turned out to be a non-event. It's pretty interesting how that just sort of went away. You'll remember Fitch slashed the U.S. credit rating from AAA to AA plus. We also saw several strikes in 2023. So the UAW, of course, across the major domestic car companies. We also saw Screen Actors Guild and different groups going on strike. So that seemed to be a theme in 2023. Pretty much all of those have been concluded by this point. So if we look at country returns, this is going back to look at third quarter because we want to sort of see where we were and where we've gotten to. If you remember, third quarter, U.S. had negative returns right there, right along the global. So the U.S. is in red, global is in blue. Pretty much in Q3, everybody was negative. There were a couple outliers: Turkey, Egypt, Norway, the UAE, India, Israel. But pretty much most countries were negative for the third quarter. Well, that changed pretty dramatically in the fourth quarter. Pretty much all markets were up in the fourth quarter. Now, what you'll notice is that high-flying Turkey, which was our number one country in Q3, all of a sudden falls down to the very bottom of the list in the fourth quarter. So for the most part, everybody was up. You can see the U.S. beat the global market by just a tiny amount. But overall, global markets were up for the fourth quarter. So moves from Q3 to Q4, U.S. jumped up one spot, global jumped down one spot. You can see Poland jumped up 46 spots. So there's been quite a bit of movement. And, this chart really sort of speaks to the diversification idea again, but not diversification across large cap, small cap, mid cap, or diversification among value and growth, but global diversification, right? Poland jumps up 46 spots, but Turkey jumps down 47 spots. So if you were all in on Turkey in Q3, well, you took a bath in Q4. And so having a diversified portfolio doesn't just entail what companies you invest in, it also entails what countries you're investing, because we see this sort of movement fairly frequently. Just because it's a top performer this quarter doesn't mean it'll be a top performer or a bottom performer next quarter. For 2023, obviously US was positive. It beat the global market. Again, here you can see on this chart, most economies, most countries were positive for the full year. We did have notably some negative countries. China had a negative return, Hong Kong, Thailand, Turkey, Kuwait, Finland. But specifically and significantly, that China being a negative return is pretty interesting for 2023. Okay, taking a look at the Edgar Sector Rotator. As a reminder, what is the Edgar Sector Rotator? Well, it is a proprietary quantitative model that we've developed here at Edgar Investment that seeks to identify what sectors of the S&P will outperform the underlying S&P. So there are 11 sectors in the S&P, from materials, communication, all the way down to healthcare and consumer discretionary. What our model, the Edgar Sector Rotator, looks to do is identify which ones of those sectors we should either overweight or underweight. relative to their market weight. And if you look in this column all the way to the right, it says won or loss. We consider a win if the sector outperforms and we overweighted it, or if it underperformed and we underweighted it. Those two possibilities are considered a win. What's a loss? Well, if we overweighted it, but the sector underperformed, or we underweighted it and the sector overperformed, those would be considered a loss. We're trying to do well we're trying to overweight when it does well, underweight when it doesn't do well. Anything other than that is going to be a loss. So what you can see is that the Edgar sector rotator had 6 wins and 5 losses. So 11. So we've got 6 of the 11 sectors we called correctly. That was our same record for last quarter. We got 6 out of the 11 sectors called correctly. Okay, so what are we? What is the model calling for in Q1 of 2024? Well, in terms of our overweighting, we are overweighting materials, communication services, consumer staples, real estate, and healthcare. So because we're overweighting those, we believe that those sectors will perform better than the underlying S&P. What are we underweighting? Well, we're underweighting energy, financials, industrials, utilities, and consumer discretionary. We think that those sectors are going to underperform the S&P. Information technology, we are market weighting this. So we do not have an overweight or an underweight. We're simply going with the market weight of information technology. So that's what we're predicting for Q1. Now, I will say this is not investment advice. Everybody's situation is different. So if you do like this model and you do like these weightings, I would encourage you to look at this and see if it works for your specific situation. But you definitely want to take caution in investing in any of these sectors based on our recommendations. All right, so let's drill down a little bit into some specific markets. So taking a look at the U.S. stock market for the fourth quarter, U.S. equity markets, we've already talked about this. They performed positively. They beat U.S. developed. They also beat emerging markets. Here, value actually underperformed growth. So growth did better than value within the large caps, but value outperformed growth when it came to small caps. Small caps outperformed large caps when we look at the U.S. market, and real estate indexes outperformed the equity markets. If we look at U.S. stocks for the full 2023, again, we've talked about this before, U.S. outperformed both developed non-U.S. and emerging. Value underperformed growth. So going back to the Magnificent Seven, those are all growth stocks. They really just sort of dominated the U.S. market, but growth in general dominated value. Small caps underperformed large caps for the year. Real estate, while it outperformed in the fourth quarter, real estate for the year underperformed the U.S. equity markets. When we turn and look at international developed stock markets, developed markets outside the U.S. did post positive returns, but they underperformed U.S. markets, but outperformed emerging markets. Here, again, just like in U.S. markets, value underperformed growth, so growth did better on the international developed. Small caps outperformed large caps for the quarter. I would like to draw your attention to the section called ranked returns, where we see growth, small cap, large cap, value. We have 2 bars here. So we have the local currency, and then we have the U.S. currency. And what you'll find is that in the fourth quarter, a significant amount of your return, if you were a U.S. investor, came just from the currency effect of investing U.S. dollars overseas. So if you were a hedged investor, meaning that you did not expose yourself to any currency risk, you would have received that sort of gray line. So when it comes to growth, you would have received 7.18% in terms of international developed. But if you were an unhedged investor, meaning you got your return in the foreign market and then brought that return back into the US, you actually would have gotten that 12.52% because of the currency translation. What happened to our currency, the US dollar, versus whatever international currency we're talking about, the euro or the yen or whatever it might be. That was an unhedged position. So you really benefited to a significant extent as a US investor just based on what's happened with the US dollar. So that's a pretty interesting slide there, in that a lot of the performance is coming just from the currency and not necessarily the underlying performance. International developed stocks for the year, again, they had positive returns, but underperformed US markets, but outperformed emerging markets. Here, value actually outperformed growth on the international developed for the full year. Small caps underperformed large caps. And if you look at that ranked returns section, you can see that the currency effect, the difference between that gray bar and the blue bar, sort of narrowed for the full year. So you didn't get quite as much of a bang for your buck when it came to currencies when you look at the full 2023. All right, moving on to emerging markets for the fourth quarter. Still, we had positive returns, but emerging markets lagged US and non-US developed. Here, value outperformed growth on the emerging fourth quarter, and small caps outperformed large caps. Again, you can see there was a currency translation differential between returns in local currency and returns in US currency. For emerging markets for 2023, the full year, again, positive returns for emerging markets, but again, they lagged US and non-US developed. Value outperformed growth, small caps outperformed large caps. So that's sort of the opposite of what happened on both the developed non-US as well as the US. And you can see here, if you look at the ranked returns, for instance, small cap, you actually were better off hedging, which would be that gray line, than you were not hedging. So you actually had a reduction in your return due to currencies. All right, let's take a look at global fixed income. So moving on from equities, taking a look at global fixed income. Increased interest rates generally decreased across global developed markets for the quarter. So you can see, if you look at the very top middle, that's the US yield curve. At the end of September, that's the gray, sort of the light gray bar. We were a little bit higher than we were towards the end of the year. That's pretty much the case across the board, with the exception of maybe Japan. There were, let's see. Yeah, so Japan had ultra short-term nominal interest rates were negative. In fact, in the UK, Germany, Canada, and Australia, the short-term segment of the yield curve was actually inverted. So remember, an inverted yield curve has a downward slope, where a normal yield curve, we normally expect sort of an upward slope. Pretty much the same story on global fixed income for the year. What's interesting about these yield curves is, if you look at the US, for instance, it almost looks like we made no progress, or we had no changes in yields throughout the year, right? We started 2022 at one level and we ended at 2022 at almost the exact same level. That blue and gray line are pretty much right on top of each other. Well, there was a significant increase in that line throughout the year. In fact, you can even see if we flip back here um, to the quarter, at September 30th, we were higher than we were at 12/31. So even though we began and ended the year basically the same in terms of yield curves, we did have an increase and then a decrease in those yield curves. Overall, a pretty good market for fixed income investors. Yields are up. We would be expecting to see yields continue to decrease in 2024, especially with Fed funds rates predicted to come down. If U.S. Treasuries can reestablish, their credit rating, we would expect for yields to continue to come down. They're at a high relative to where they've been over the last 10 to 15 years. So just a little bit more of a drill down into U.S. Treasury yield curves. You can see here we've got the 12/31/22 curve. We've got the 9/30/23 and the 12/31/23 curve. Again, you can see we started at basically the same level we're at now, but there was that increase throughout the year. All right, so let's take a little bit of time here to do some Q&A. We're actually right on schedule. We're actually ahead of schedule, so we have plenty of time for Q&A. So if you have any questions, go ahead and submit them into the chat. So the first question we had was about the recent antitrust trial that the DOJ brought against Google, and does this have any impact on companies in terms of decisions they make going forward? And so, kind of maybe take a step back and explain what this Google antitrust trial is all about. So, the DOJ alleged that Google has used its position in the search market to, basically dominate and maintain monopolistic, power over the search market. And if you look at this chart on this page, you'll see the global market share of search engines since 2015. And I mean, sure enough, Google does dominate search. I mean, they're right up above 90%. I mean, there's nobody that's even remotely close. I mean, the fact that they have 90% of the market share, nobody would even be able to get close. And so the Department of Justice basically said, is this a case where Google just provides a better product than everybody else, and that's why they have so much market share? Or is this more of a case where Google uses its market share to unfairly exclude other competitors? And the Department of Justice, of course, has argued that it's the latter, that they're using their position to exclude other competitors. And they've pointed to a variety of things that Google has done in that realm. So, for instance, coming up with agreements with device makers and software companies to where Google search is sort of the first and only search engine that you see and use. Is in terms of how this impacts other companies, I think Google's sort of in an interesting situation where it's not your traditional, search is not your traditional monopolistic industry. It's not a railroad or utility, electricity provider. On the outside of it, it would seem to be a fairly competitive industry, right? You come up with a better search engine and people start using your search engine. That's what Bing has been trying to do for a while now. So it's an interesting situation that Google finds themselves in. And I think it's sort of unique to them. What I do think is we can expect to see is the Department of Justice does seem to be more intent on breaking up monopolies or preventing mergers where there would be a concentration of market share in few participants. Most recently this week, we saw the Spirit JetBlue merger kind of go down in flames, no pun intended, uh, brought about by the Department of Justice, basically saying that this would concentrate too much power in too few airlines. Now we've got some pretty massive airlines already, um, so I think that that's what we would that's what companies need to be aware of, is that there is a possibility that this Department of Justice, specifically under a Biden or a Democratic administration, is going to be more aggressive at going after companies and trying to maintain competition in markets where they can. I don't think that that's necessarily the same case if we see a Republican administration come in. I think we're going to see them sort of back off some of these antitrust cases and probably see more mergers go through. So I think that's where, that's sort of what we're seeing here, is that we have a little bit more aggressive Department of Justice when it comes to these mergers and monopolies. So another question that we had was, so the U.S. now has debt that is well over 100% of GDP. Specifically, it's 121% of GDP. And the question was, does this portend poorly for U.S. stock markets? And we have some research that came out of Dimensional Fund Advisors. Wes Krill, their senior investment director and vice president, did a study. And in this study, they looked at markets, economies, we should say, countries, and looked at their level of GDP and debt to see if there was any sort of correlation between debt and GDP, specifically a negative correlation. So if a country racks up a lot of debt, do we then expect to see a decrease in stock performance? And ultimately, what Krill's paper points to is that there is not really much of a correlation. In fact, stock performance has generally been positive, even when we see high debt conditions. Specifically, Japan has had a lot of debt for a number of years. Italy, Belgium, there's other countries out there that have had significant debt. So we can study this sort of thing, and it does not appear that a high level of debt relative to GDP has a negative impact on stock performance. And I would say, generally speaking, markets tend to go up. There's sort of an upward bias in markets. Now, that's not always the case. I mean, we do have periods of negative performance, but generally speaking, markets tend to go up. So irrespective of what the economy's debt level is relative to GDP, it seems like that sort of upward bias in markets continues to hold. So very interesting article. I'm looking and I do not see any questions. So we actually got through this well ahead of time, record time actually. So I just want to say thank you to everybody that has tuned into this webinar. Of course, we do these quarterly. We'll have our next webinar in about 3 months. So stay tuned to your email, social media, of course, for the announcement on when that first quarter 2024 wrap up will be. Of course, we'd love for you to visit us online. Edgarinvestment.com is our website. We also have a LinkedIn page where we post daily kind of summaries of our daily blogs. We have a YouTube channel that I mentioned earlier where we're going to begin posting even more videos. Of course, you can pick up the phone and give us a call. We're on Instagram at Edgar_investment. We post daily updates on there. And we're on Facebook. We post daily updates on there. So whatever your social media or communication preferences, you should be able to get a hold of us. So with that, I'd like to wrap it up and say thank you for attending, and definitely be on the lookout for a date on our first quarter 2024 presentation. And thank you.